Good afternoon. My name is Chaudhry Muhammad Aziz Anwar. Today I will present a case study on sales tax and service tax with reference to Vesta Industries in Malaysia. We'll cover the company's background, analysis of six key transactions, consolidated tax exposure, opportunities for relief, refund eligibility, compliance considerations, and finally, a conclusion. Industries manufactures household kitchen appliances such as blenders, coffee makers, and toasters. These are classified as taxable goods in Malaysia. Sales tax is applied at a single stage rate of 10%. The main objective of this presentation is to calculate sales tax on Vesta transactions, identify possible exemptions, discuss refund options, and highlight compliance risks. With imports, Vesta imported raw components worth 400,000 on a CF basis. Custom duty of 10%, that is 40,000, is added to the base, giving a total taxable value of 4,40,000. Applying the 10% sales tax rate, Vesta paid 44,000 directly at custom during clearance. This illustrates how imports create an immediate tax burden. Next, Vesta made local sales of 1.5 million at the rate of 10%. Sales tax of 1,50,000 were charged to customers. Here, Vesta acts only as a tax collector and must remit this amount to the custom authority. The real burden falls on the retailers who purchase the goods. Vesta also exported goods worth 300,000. Exports are exempt from Malaysian sales tax, so there is no liability here. This exemption encourages Malaysian manufacturers to compete globally. Distributed 100 blenders free of charge, each valued at RM 100, totaling RM 10,000. Under sales tax rule, even free goods are considered taxable once they leave the factory. At 10%, this results in a tax liability of RM 1,000. Rejected or defective units worth RM 20,000 were sold to a recycler. Since these are taxable goods being sold, sales tax still applies. 10% of RM 20,000 equal RM 2,000. This demonstrates that sales tax applies even when goods are sold below standard or for scrap. Vesta purchased a new production machine from Germany for RM 200,000. Machinery used directly in manufacturing is exempt from sales tax under the sales tax order. Therefore, no tax is payable on this purchase. Adding up all the taxable transactions, RM 44,000 on imports, RM 1,50,000 on local sales, RM 1,000 on free samples, and RM 2,000 on defective units. In total, Vesta's estimated sales tax burden for the year is 1,97,000. Vesta can minimize its tax exposure through available reliefs, exemptions already used for machinery, suspension schemes like licensed manufacturing warehouses and free industrial zones, which allow deferral of sales tax on import used for export production, relief on certain raw material purchased exclusively for exports. These measures can reduce financial strain. Unlike GST, the sales tax system does not provide input tax credits. Refunds are only possible if goods are re-exported, sold to designated areas such as Lebanon, Langkawi, and Tioman, or in cases of overpayment. In Vesta's case, the sales tax paid on imports cannot be recovered. Two major compliance risks must be highlighted: misclassification of products under the wrong tariff code, which can lead to disputes and penalties; non-declaration of free samples and scrap sales, which may be flagged in audits. Additionally, accurate filing and proper exemption documentation are essential for compliance. In conclusion, Vesta faces an estimated sales tax burden of 1,97,000, mainly from imports and local sales. A strategic approach using exemption, suspension schemes, and strict compliance can help reduce tax exposure and avoid audit risks. Effective tax management is crucial for financial sustainability. Thank you so much for your attention.